expect the small and mid caps to start outperforming because there has been a significant amount of lag over there over the last couple of years as far as equities are concerned. And from a bond market perspective, clearly bond markets have turned extremely attractive thanks to the way rate hikes have happened across the spectrum over the last 1 year or so. So let me quickly jump to how the markets have been in the month of April. So until April, you will clearly see that on a YTD basis, if you look at the CYTD column, clearly compared to other global markets, whether it's developed world or even the emerging world, India or Indian markets have been lagging a bit. However, if you look at the markets over the last, say, 1 or 2 months or 3 months, you'll clearly see that performance in Indian indices have also picked up, and the amount of divergence that we saw through the earlier part of the year, maybe some bit of that has been clawed back. From a key commodity perspective, Brent crude has substantially corrected, and now when we made this report, it was trading at closer to $79 to a barrel. Today, that is trading closer to $73. So from a last, you could say 3 or 4 months perspective, crude oil has come off substantially. Gold prices continue to hover around $2,000 to an ounce mark, while the dollar index too has seen some amount of correction. So the appreciation that the dollar saw last year against most of the major currencies, a lot of that has reversed this year. Yields have fallen as far as Indian markets are concerned. So from around a 7.5% yield on the 10-year benchmark government bond of India, that has fallen to around 7% now. US 10-year has also corrected. These are some of the internals in Nifty in terms of how certain sectors have done or how different market caps have played out over the last 1, 3 months, 6 months, and also over the last 1 odd year. On a YTD basis, if you look at some of the key sectors, maybe IT is the only sector apart from you could say telecom, which is not really delivered too well. If you look at some of the sectors like capital goods, FMCG, or even auto, they've done phenomenally well, ranging between 5 to 10% returns over the last 4 odd months. Power, oil, and gas continue to sort of underperform. If you move to the global picture very quickly, what is changing is the entire narrative from a perspective that last year has been that of aggressive rate hikes of large quantums, unforeseen before in the past. That has now clearly moved to an expectation globally that the Fed will now pause. So if you look at the current market expectations for the June policy, a lot of analysts across the globe expect that the Fed will not deliver any further rate hikes. It'll pause for a while and after that start cutting rates, because unlike in India, which still expects to clock in a GDP growth of anywhere between 6 to 7% basis various estimates, it's very clear that US is headed into a recession. And there are a lot of indicators that do sort of give an advance warning in terms of a substantial slowdown in the US, while there are a few other mixed signals from the labor market, which I'll maybe cover very quickly in the next minute, in terms of why Fed continues to remain in that dilemma in terms of whether they should be really going ahead and cutting rates, as the market expects from somewhere around September, or will that be more towards December or early part of 2024? Well, having said that, the clear, you could say, progress that one expects on US rates from here on is to plateau and then maybe move down. Recent data that got released in the US, which is perhaps not letting the Fed relent in their current positioning as a rate hawk, continues to remain on the earnings front as well as on the overall unemployment rate. So if you look at the unemployment rate, that continues to fall. The previous rate was at 3.5. Most of the analysts expected that to move up a bit, but actually it's fallen down to 3.4. Similarly, from a perspective of manufacturing payrolls, those numbers are looking better, whether it's across government, manufacturing, non-farm, etc. And also from an earnings perspective or wage earnings perspective, generally that trend is also moving higher. So that's one area in which there is no respite, and maybe that's what is holding the Fed back. And after this data, you saw some amount of upward adjustment towards US Treasury rates across the spectrum. However, if you look at the business momentum in the developed markets, now this is the right-hand top chart actually talks about the industrial production, and that number indicates that there is a definite amount of slowdown in industrial activity as far as the US is concerned, or even UK is concerned. Similarly, manufacturing index, the PMI, which is generally a lead indicator as to what is to be expected in terms of industrial activity, that has started pointing towards contraction. So any number below 50 on the PMI actually means that the activity on a manufacturing front is slowing down. Also, from a global trade perspective, there is a clear slowdown that's been seen over the last, you could say, 12 to 18 months. And maybe some of these parameters would, in our opinion, push the Fed to pause and towards the end of this year, talk or start changing the narrative towards a rate cut. Indian macro, some high frequency indicators for a quick view of where we are. Liquidity in the system remains tight. We are looking at almost 1.6 lakh crore of liquidity sort of deficit in the country. In fact, the recent, you could say, not a ban, but the notice that there's going to be a limited time for which we can use the 2000 rupee denomination notes going forward, and there's an outer timeline for everyone to exchange those, means that there will be a lot of money getting deposited in banks, and to that extent there will be some amount of support that the banking system liquidity will get because of this near-term adjustment in terms of people depositing their notes towards to the banks. That is reflected in some of the very short-term rates in the market today, which had started hovering around that 7% mark, who have come down by at least 20-25 basis points. So that's a good or a positive from a bond yield perspective. If you look at maybe some of the other parameters like non-food growth, credit growth in the economy continues to remain fairly robust. This number of 15-16% has been seen over the last couple of months or quarters now, which means that overall credit growth in the banking system continues to be good, and that is in fact reflected in the quarterly earnings numbers that banks are delivering. So rates have moved up almost 70%, 75% of these rates have gotten transmission into the lending rates. And with a higher credit growth, overall, that's helped improve the net interest margins for a lot of banks and other NBFCs, and that's a positive. In terms of passenger vehicle sales or two-wheeler sales, which is a proxy for how consumption is shaping up in the economy, discretionary spends, you'll see that that number has fallen off in the month of April from that we'd seen in the month of March. And overall, it's more comparable to what these numbers were 1 year back. Probably that also indicates that, while overall credit growth is good, but maybe some of the consumer spends or discretionary spends are getting pushed back, given that, car and vehicle prices in general have moved up by 20 to 30%. On back of expensive commodities or raw materials over the last 1 odd year. And at the same time, overall lending rates having moved up. Probably some people for whom this was not more of a make or break decision, they're pushing forward their purchase plans. Power consumption seems to have slowed down, but that is clearly because of some amount of unseasonal rains that we saw across the country during March and April. And to our minds, that should see a quick reversal when the May numbers come out because of the sweltering heat that we're seeing across most of the major parts of the country. And overall electricity consumption should have gone up, so power consumption numbers would be up. After moving into the new financial year, generally the month of April is a little slow, and maybe economic activity would have also moved back up to the normalized sort of rates. And that's what we'll also see power consumption move up, in our opinion, in this month and in the coming months. If you look at India's manufacturing index or the PMI number, clearly, at 57, it's one of the highest that we've seen in the last many, many months. And if one were to try and extrapolate that towards what to expect from an industry's growth perspective, it clearly indicates that we're in for a very robust core industries or overall even IIP numbers coming forward. A GST indication of 1.87 lakh crore is a first time that we've actually reached that 1.75 lakh crore mark, and it really augurs well. It talks about more compliance and in general more activity happening from economic perspective. I'll skip the GDP numbers because these are dated. These are for the December quarter. The March quarter numbers are expected soon, and maybe that should give us an indication of how the overall growth for this year in the country has been. RBI has recently published its revised estimates for FY23. They're pegging India's GDP growth to come in at 7%, which is like the fastest in the world right now. Quickly coming to equities, if you look at the trends in terms of flows, you will see that FIIs, which turned out to be positive buyers or net buyers of equity in the month of March, they continued that trend in the month of April. So in April itself, FIIs bought around 1.4 billion net equities. If you look at the last sort of chart, and on a YTD basis, while FIIs continue to be around 1.7 odd billion negative, but if this trend continues, we'll expect FII buying to keep helping and supporting the markets. From a domestic institutional perspective, we see that if you exclude MFs, which were who were buyers of equities to the tune of 1.3 billion, the other institutions like insurance companies, etc., they were net sellers of 1 billion. But as a pack, they have been able to add around 0.3 odd billion net positive. What's interesting to see is the left bottom chart, if you can focus there. March numbers for SIPs were upwards of 14,000 crore. So MF SIP numbers now have averaged closer to 13,000 crore now for the entire FY23, which is phenomenal growth versus what we saw in FY22 and 21. So if you look at it on a year-on-year perspective, on monthly flows itself, we are clocking a 15-16% sort of growth every month. At the same time, if you look at it also from a cumulative FY perspective, that's a very, very strong number. So that's one reason why, because this sticky money, it keeps coming every month, and there's a lot of resistance or a lot of inertia for any investor to stop an ongoing SIP, which augurs very well for the market. Clearly, given that it supports the market, across different cycles, even if there is a little bit of negativity around. Coming to valuations, Nifty broadly by any parameter you look at, whether it is market cap to GDP, forward Ps, price to book, broadly it's trading at long period averages. So the froth that we were seeing in the market built up towards December when Nifty touched around 18,000, 18,900 odd levels, that has clearly gone away with the recent volatility that we've seen in the market. And which means that, from a price point, this is a much better point to enter or to create some sort of portfolios looking at 1.5, 2 years out. The divergence that we've seen or that we saw between fixed income yields that were more attractive compared to equities maybe a few months back, that has also compressed. So there will definitely be some amount of realignment or positivity towards equities that we foresee. Earnings wise, we think FY24 we have to be cognizant about 2 or 3 key variables to track. One is the entire BFSI pack. So banking and financial services accounts for almost 35 to 40% of the index. And in general, if you look at the last 5 years for banking and financial services, FY18 to FY23, it's seen a 5x growth in earnings as a pack. And it needs to be seen whether this normalizes now in terms of its growth trend going forward, or do we continue to see this sort of a trajectory in terms of earnings growth, because that to our minds will clearly drive the next leg of returns even for banking as a pack. And why it's important to track from an earnings perspective is because if you look at the last 1 or 2 quarters, if you remove banking, from the entire Nifty in terms of earnings growth, the rest of the market has been growing, at low single digits, or in certain cases even not really growing. So growth from a banking sector contribution perspective is necessary. In our opinion, domestic consumption, like we're seeing from slowdown in auto sales, etc., might remain for a while as long as rates remain higher in the system from a perspective of lending rates. And overall, that might lead to some amount of slowdown from an earnings perspective. And the critical aspect is the third leg, which is export-oriented sectors or sectors which are more dependent on their earnings to come from exports, which is primarily sectors linked to tech and commodities. That also forms around 40% of the Nifty profit pool. And a weaker global growth means lesser spend on tech, and that could have a certain bearing on what to expect from these companies going forward. So near term looks clearly a little bit challenging, but what we believe is that a lot of the play in terms of a negative impact of higher commodity prices overall on earnings numbers, maybe that has played out. If commodities continue to remain benign in terms of the price point that we've been seeing as a trend over the last 4 to 5 months, if that continues, that should start supporting earnings a bit, even if there is some amount of slowdown at the top line level. So broadly, if you look at the EPS downgrades for this year, and for the next year, it's been fairly modest, in terms of 2 to 5%. So we have not really seen a very sharp downward correction in expectations of earnings, and that, to our minds, means that market will not see a very substantial downside from where we are today. This is one indicator we track, which talks about how Nifty 1-year forward returns are. From different valuation perspectives. This is more of an earnings sentiment index. So where we are today, it's more of a fair value. So it's neither too expensive nor too cheap. Our sense is that it might remain where this is. Maybe there could be mild, correction seen over here, but that means it continues to see, a reasonable entry point for investors from where we are. Another point where a lot of people do question on is how is India placed versus the globe, and clearly the premium that we were seeing somewhere around August, September, October of last year, where we were trading as a country compared to MSCI emerging markets, we were almost at 100% premium. I think that premium has fallen down to 60% now, and which is closer to long averages of around 40-45. So, which means that a lot of divergence has gone away. And that's thanks to also some amount of correction in India. And also at the same time, countries like China have seen a significant outperformance over the last 5 to 6 months. And that, to our minds, has reduced or bridged the gap in terms of how India had outperformed through most of 2022 and where we are today. Generally, if you look at the global strategists, they don't see a great profit growth coming in the US or in Europe, and that clearly corroborates to the fact that slowdown is on the cards over there. As long as this trend continues or the expectation continues, we do believe that Fed or other central bankers will start really course correcting sooner than expected. One interesting point, while we are through most of the May month, but the general adage has been sell in May and go away, because that's the typical trend that we see, where a lot of investors move money out in May, institutional investors globally. What we've done is put a table for the month for Nifty, and we've tried to put in over the last 22 odd years what is the lowest point in the month of May. And from there, what have been the next 7-month, 8-month returns, till the end of the year. So you will see clearly that the average returns have been around 20-21% if one were to invest at the bottom prices or near bottom prices in the month of May. And very rarely have the returns, having invested at that point in time, turned to be negative. So our take over here is that the month could be volatile, but maybe the global adage doesn't really apply to India in the same way as it applies globally. And this sort of a seasonality in returns that we see in this year could clearly be used to build portfolios or stagger investments or buy the dips sort of a strategy. SMID is small and mid cap. So we've seen a significant uptick in returns in the month of April for small cap and mid cap. So the earlier slide I showed clearly indicates that mid cap generated around 7%, or small cap indices generated around 7 to 8% again in the month of April itself, versus a 3-4% for Nifty. So we've been bullish on this space for the last 8 odd months. In fact, we've been amongst the early proponents of broader markets trying to outdo the frontline indices over the next 2 to 3 years. While the call is still not played out, because we are still trying to see if mid and small cap earnings recovery is sort of sustainable. But maybe what's happened in the last 1 month could augur very well for both the mid caps and the small caps going forward. So broadly, our view is that you have to stagger investments into the market. This year is going to be that of testing our patience. But if you were to look at small and mid cap oriented ideas, maybe that will help portfolios to construct very well. And on that side, we have a few PMSs and a few PMS managers who have clearly demonstrated alpha, and have portfolios which are absolutely, you could say, less overlap with some of the traditional mutual fund and PMS investments. Quickly on the fixed income, the yield curve you can see is clearly flattish. And we do believe that most of the rate hike has happened. And we expect the RBI to be on a long pause from here on. And to that extent, we believe the 10-year might correct further. 10-year is corrected from 7.5 to 7%, could go down to 6.5%. And in our minds, the best way to play a fixed income market is to increase duration in portfolios. Tactically add around 35-40% of your portfolio towards duration, which means having portfolios of 7-year, 8-year, 10-year sort of maturity in underlying funds. And because the credit environment is great in the country and the credit spreads are also attractive, there are a lot of products that we do offer and they're available in the market that help you participate in that space and get around net yields of around 10 to 12%, or at a gross level even as high as 15 to 17%, with regular cash flows, and that those could be good additions to overall improve the yield on the portfolio. So that's broadly what I wanted to cover as far as the markets and view and our ideas are concerned. Maybe what I'll do here is pause and let Nitin come in and share his perspective. Thank you.
Also, while Nitin comes in, I think if any of you have any questions, you could always use the Q&A chat box to put in your questions, and we can take them after Nitin's session. Thank you.
1 minute. Radhika, can this be seen?
Yes, Nitin, it's showing.
Okay. Thank you, ladies and gentlemen, for giving us this time today evening. Saurabh has given you a very comprehensive view on the markets. I just want to kind of integrate maybe the long career that I have had in this line to kind of correlate some of the things that Saurabh has said, and also to kind of give some broad thoughts which could help you fine-tune your wealth perspectives. So I start with equities because I'm a firm believer that wealth is created through equities and protected through debt. So I keep telling people that promoters of big companies became rich through equities and then they started investing in debt. So I would like to cover equities. I just want to start with this chart, which always worries me as I see investment in equities. It kind of traces the career path that I had when I started my career. So broadly, I started in 92. And if you see this, if you see this graph till 2004, which is for 12 years, while India was doing okay, the markets went nowhere. I like to highlight this because while we all see the bullishness of the market in the recent months, we forget that for 12 years, the markets went nowhere. There have been 3 or 4 phases in that period when all the gains were lost. And I think in investing, one needs to keep this perspective that it is possible for 10 to 12 years, the market goes nowhere. And then if you see the phase after 2004 to today, you actually see that the breakouts of the markets have been just 2 or 3. And if I look at it broadly, it would be when reforms were done. It was when a new government with a different ideology in terms of development came in, and COVID when it was liquidity. So again, there are periods when the markets do well, and one has to kind of be invested for these breakouts. What has supported markets throughout from maybe 2004 is that our GDP has grown, and which is what the markets reflect. However, if I was to draw a line, which I represent in that blue line, and I would presume that that would be a gently sloping line, it's obvious if you see this that the market has gone away from its mean. And maybe it's the participation of the retail investor, etc., who's caused this mean, and the liquidity during COVID. So I just want to highlight that whatever we do, we have to look back and down as we look at the bullishness that most analysts talk in the market, because this is reality. So technically, it is possible that markets can come down, say, to 45,000 or so. Doesn't mean anything, but one should realize that it's not that India has always had a bull run, and people should keep it in mind. The second slide I want to highlight is taking mutual funds as a proxy. I just wanted to see for the equity markets what returns would have been made in different time frames. And you can see that 10-year returns on large cap funds were 12%, mid cap funds was about 17%, small cap was 18%, and the indices also gave somewhat similar returns. So what I am trying to say is it really doesn't matter whether you invest for 1 year, 10 years, or 15 years. You have to invest long term, because the market always comes to the mean. And that is where I keep telling people, and that's what I've practiced through my career, that history of the market tells us that 10 to 13% return on a CAGR basis has happened irrespective of any shocks, assuming GDP keeps growing. And that, I would say, should therefore be part of your core portfolio for making your returns. The market is also giving us a sign that 3 years, the returns were in the range of 25 to 44%, depending on the product category, which is where the tactical portfolios come in. So for investors who want to build wealth over 15 years, then clearly core portfolios of mutual funds or stocks, which could be large cap, mid cap, small cap, will clearly give you the wealth creation that you aspire to do for yourself, for your children, etc. And for people who are interested in the short term, definitely there'll be 3-year kind of peaks which will come in, which you can participate. I here want to highlight the difference between large cap, mid cap, and small cap in investment strategies. And if you see the 10-year period that I highlighted, mid cap gave 5% more return than large cap, and small cap gave 2% return more than mid cap, which means that absolute difference between small cap investing and large cap investing is actually 70% in 10 years. So therefore, investing should have proper small cap exposure to maximize your returns. In terms of basic strategies, I've said that one should not bother too much. You have to have equities. It is better than debt for wealth creation. Market has shown a performance, and you can easily think of a 12 to 18% return over long term. Again, assuming here that India grows on a 6 to 7% or 5 to 7% kind of GDP continuously over the long term. Risk profile matters, and actually what I am telling you is more for conservative investors because of the way I look at equity markets. Aggressive investors have an entirely different ballgame to think. What is important, however, in equity strategies, in my view, is exits, because you cannot plan when to exit, however good one may be. So it is important that one catches boom times, euphorias as need points to take some money away from the market. You have to create these artificially. If the average is 15 to 20% and the market gives 40%, maybe aggressive investors can make some exits. And I keep saying this, and it's very important because nobody predicts exits properly. Important to compulsorily define needs and accordingly take exits in markets, assuming that what I've said continues for the next 15, 20 kind of years. The second part, the other part that I want to highlight is that into the future, there is a need to, if everybody makes 12 to 18% return, what is so great? Everybody creates wealth. But I've always believed that wealth is relative, and the markets have evolved today where I think almost everybody invests in equity mutual funds or direct equities. So relatively, I don't believe extra wealth will be created, because my belief is that inflation and costs go up in line with market wealth creation. So if one has to create more wealth than the market, other strategies are needed. And this is where I think a lot of people are saying that India today is in a certain point which has never been seen so far. And just recently, there was a newspaper article in Times of India which highlighted a Knight Frank report, which said that 58% increase in UHNIs, that is people having more than 30 million USD in 5 years, and 107% increase in HNIs, which is people having more than 1 million USD, which is from 797,000 investors to 1.65 million investors. It is very, very important that our investors participate in this growth, because otherwise, relatively, you're going to lag behind. We interact a lot with international investors and views that come in because of the nature of our Interact group. And a lot of people are saying that the next decade is going to see the same transition that China saw in the 2007 to 2011 timeframe. And at that point of time, in 2007 to 2011, the nominal GDP in China grew by 100%. Morgan Stanley in his report has said the same growth is expected to happen in the next 10 years. What it means is that the number of dollar millionaires in India is going to increase sharply. You've already seen it happen in a certain phase of the boom market, where people in companies like Paytm, in Zomato, in even DMart, etc., became millionaires just because of the entrepreneurship risks that they took. And in that phase, therefore, the type of millionaires that will come out in the future is going to be very different. And so, again, the relative wealth concept becomes important. And that is where Incred, me, and my boss, who's also seen a lot of international wealth, strongly believes that 20% of portfolios in this market should be towards wealth acceleration, so that you are not left behind and participate in the evolution of wealth that's going to happen. Therefore, for that, I personally believe that a small cap focus is very important. Typically, small caps in the 500 to 2000 crore market cap range over 10 years should easily go to 10,000 crore kind of valuations if they do well. It can be through funds. Saurabh did mention some of some small cap funds, or it can be through direct equity if your equity picking skills are good. Definitely, one should consider private equity investments at early stages. Carries risk, so you need distribution of 5-10 holdings, and it should be considered as an asset category as your wealth matures. And you should use people like us or others to kind of hope that disruptors are picked up. I was reading somewhere that big disruptors which will happen over the next 10-15 years are in the area of transportation, energy, food, and manufacturing. So I would essentially say that 20% of your portfolios need to see kind of 10x kind of growth over, say, 5-6 years kind of time frame, if you have to catch up with what is going to happen in India through the entrepreneurship and wealth expansion. Just in all that, you should possibly use wealth managers like us who have an IB kind of approach, investment banking approach, or understanding of global wealth to ensure that good, fundamentally sound investment should be done in whatever you kind of do. Short term, Saurabh has mentioned that equity markets, while interesting, are kind of costly. So our technical analyst does say that there could be a trend of profit booking in the short term, and the chart clearly shows that it is hitting levels. Interesting chart that I want to show is this. I did show you the chart from 1992 and behind, but this is a 5-year kind of basis. And even a layman can see from this that the markets are at peak levels, and in my view, supported by retail investors, etc. And hence, at least large-scale investing carries risk at this point of time, and you need a strong event for a breakout. However, recognizing the fact that one can't afford to be out of equity because of the 12-14% kind of return that I did mention, at least in large cap, you invest through dips or in phases or through products like structures which protect the downside to some extent and give you upside kind of participation as the markets go out. Again, we believe in the long-term India story and the bottoming of the world, but clearly long-term Nifty and Bank Nifty seem costly to enter. The chart shows that even the mid-cap and small-cap in the short term are entering costly levels. But this is an interesting chart, which is the small-cap index over 5 years. And just to correlate it to the large-cap index, it is at its peak. This is the Nifty large-cap index, and this is the Nifty small-cap index, which is not at its peak, and it is broadly 25% below that. So, and the Indian economy is doing well, I think small caps are being recognized, and when I say small caps, even private equities. So it is possible to identify good small cap stocks, not so much mid cap, and participate in a possible 20-25% rally, which we would expect in the maybe 6-month kind of period. And the charts are clearly showing that that is going to happen. The only challenge in small caps is the field is very large, and you have to be able to choose good fund managers, because small cap stocks are not so easy to manage. It is a function of market dynamics, investors. It is like a PE investing, where you need to know the fundamentals in depth, you need to know the promoters in depth, and then you need to ensure that the demand supply equations are favorable, which is where I think you need good small cap fund managers, or you do good analysis in the technical space. And in my view, this is very, very attractive in the long term. So summarizing, for me, equity is a must-have, and I don't think it is that risky if you take perspectives of 10 years. And in my view, 10 years is not such a long perspective to think of investing. And I think people should follow that. The second question is, what about debt as an asset category? The way I look at debt is slightly different. I look at debt, when you look at debt, you look at interest. And the number that everybody talks is inflation. And I think there's a divergence between how most analysts talk of inflation and how a real investor looks at inflation. We all know inflation should be 4% to 6%, but reality inflation is as high as 10%. And most products in the core fixed income space benchmark themselves to reported inflation. And if you see this chart again, where I use mutual funds as a proxy, whether you look at 1 year or whether you look at 15 years, the returns are 6 to 7.5%, which means that you're not even protecting you're not making any return on debt. And that is where I keep saying that equity is important. But I think now the debt market in the last few years has also evolved, because otherwise you are technically just kind of protecting whatever wealth you have made, hopefully from equity in some form. I just want to highlight from a perspective that while a lot of people keep money in bank FDs, they are unattractive other than for emergency funds, for relationship funds, etc. The disadvantages of the bank FDs are banks build their profit margins into those products, there are penalties, etc. So the core strategy in debt, other than the exposure needed for emergency money, has to be mutual funds with AAA, AA exposure that technically should give you 6.5%, 7% return over 10 years. But the markets have now evolved well in India, like international markets, where with proper due diligence, for 20 to 30% of debt portfolios or even more, you can easily get 3 to 4% more than conventional debt, be it AAA or mutual funds. Here, while your advisors will give you better inputs, one trend which is clearly emerging after the tax changes is hybrid funds or equity arbitrage plus debt funds, which will give you returns. NCDs in the A to BBB category is very interesting, with a tenure of just 2 to 3 years, not more than that. You will get easily returns in the range of 10%. Structured products, domestic and international, will give you returns in the range of 9 to 10%. Insurance, 15-year horizon, gives you good returns, though still in the AAA category. AIFs are emerging, which kind of use derivatives to give liquid plus returns. A lot of investors have targeted that. We call them liquid alternative AIFs, and it is possible to get 8% returns. This is on short term. So typically liquid funds, etc., give you 6.5. You get 8% here. And products like credit opportunity AIFs, where your money plays the function of a lender, and you actually lend as long as you're backed with high quality fund managers. Here the returns can go as high as 15%, though net of tax, it will be in the range of 10%. But clearly what I'm highlighting is debt funds today, debt has evolved in this market, and it is important for a lot of you all to target 10% kind of returns with some amount of risk which can be managed, though core portfolios will continue to give 6 to 7% risk. So broadly, I would always recommend to keep a lot of money in equities. It is conservative in nature. The data shows that you make 12 to 14% return. Whatever money you need for your needs, you move that into debt and either protect the capital by AAA investing or increase the returns to 10% or so. We've focused a lot on equity and debt, but the last slide I want to highlight is diversification. That is increasingly becoming important in India, because global wealth is now a concept that is real. Just like my children who study abroad and now carry international practices, today a lot of people are getting their children educated in international schools. Higher education is now abroad. So clearly the next generation is going to look at international investing. India carries the fiscal deficit sword, and the pulls and pushes of populism will always keep a sword hanging to the wealth that we have. Global jobs and global families are now a reality. So it's important to take exposure beyond India for a certain portion of your wealth. Right now, maybe China because it is undervalued, and ETFs, etc., and NASDAQ, which gives you foreign currency depreciation advantages. We also have a host of global bond funds and long short funds and equity recommendations, which our advisors can always give you. I think that concludes what I wanted to say. We are more than happy to answer questions that you have. But broadly, I think this is the perspectives that I would want you to integrate once Saurabh's view over the next year and what can happen, and possibly the longer term views that we want to share. Radhika, over to you.
Yeah, thank you, Nitin. I think if any of you have questions or any queries, both Saurabh and Nitin are here to take your questions. You can please use the Q&A box to ask any questions you have. In the meantime, I think Saurabh, if you want to share any specific investment ideas or our focused recommendations, you could do that.
Sure. So maybe I'll just speak about it rather than putting up anything on the screen.
Sure.
So on the fixed income side, we did mention that something on duration or medium to longer duration products or maturity products makes more sense. Given that we believe RBI has clearly paused, and maybe towards the early part of the next calendar year, we should start seeing narrative changing towards rate cuts. So a lot of you would have invested into target maturity funds, which are akin to FMPs, but just that they are open-ended in nature, and hence are more liquidable. But at the same time, they don't really get impacted by any sort of rate movements. So while it's a positive on the upside, when the rates are moving down, it doesn't help. So what we believe is we should move into funds like constant maturity gilt funds or dynamic bond funds or even medium term and corporate bond funds. That should really add a significant amount of alpha to the portfolio. A specific another input on high yielding is one of our own products. We call it the Credit Opportunities Fund. That fund is something which invests into bonds of emerging corporates which are basically around for the last 3-4 years, profitable, delivering EBITDA level positive, and at the same time where we have dealt with them, through our NBFCs in the past. So there we have, 4-year product contracted IRRs of 17 to 18%. And to ensure that, there are regular cash flows from products like these, which are typically not liquid in nature, we do follow a monthly interest as well as principal repayment payout. So your net investment holding in these products is anywhere between 2.5 years. One makes around 17-18% gross. Post taxes, we definitely make around 8 to 10% sort of returns, which is better than any of your traditional debt funds can give you. So while these are a few specific ideas, maybe I can see a few questions pop up, Radhika, on the screen.
Yeah. So the first question is, what will be the effects of US defaulting on its debt? Will it be a black swan event and a good entry point? Do you think so?
So, we don't really envisage or we see US defaulting on its debt, while there's a lot of talk around, the timeline arriving and, in terms of the debt ceiling. And we don't really see that happening. In event, if it does happen, I mean, even in that low probability, even if it happens, we believe that could definitely be a very good entry point. See, because some of these events are more, you could say, time bound or something which gets which impacts market, and markets react in a very knee-jerk manner. We saw something similar happen when the Russia-Ukraine war broke out. Even after COVID, markets really gave away substantial amount of returns from a price point, but then they were quick to bounce back in the next few months. So fundamentally, or from a macro position, I don't think anything's wrong with Indian markets or overall with the Indian economy. So that should be a good entry point in my view.
I just want to add, Saurabh.
Yeah.
We have a global view, at least on US markets, that they will correct from here, from a perspective of US going into recession and various other things. I have read in a recent article that there has been a period in, I think, 2008 or so when US, this debt crisis didn't go through. And at that point of time, it resulted in a 15% market correction. Now, whether, like Saurabh rightly said, it will happen or not, one is not sure. June 1st is not really the deadline. There is a couple of week period in that, and it is posturing. So there is that risk. And at least international markets, yes, there is an opportunity. India is in a different phase. I think people are not, if you get corrections of 10% on large caps, it's great. But in small caps, we are seeing a lot of interest in the markets. So in small cap kind of investing, I don't think there's going to be any correction that at least we envisage, and therefore we are actually recommending people to invest aggressively into small cap products right now, rather than waiting for any correction.
Thank you, Nitin, Saurabh. The next question is, we understand investing in US denominated fixed income is once in a multi-decade opportunity. Is this true of the Indian fixed income space as well?
So I don't know if this is once in a multi-decade opportunity as far as India is concerned, but it is definitely a very good time to enter into Indian fixed income. We actually, around, I think, Feb of this year, when maybe immediately after the budget, when there were announcements made around taxation related changes for market linked debentures, etc. And broadly, from a fundamental perspective, we saw that the government is not really increasing its borrowings programs, significantly. And with most of the rate hikes being past us, we gave a call that we should start looking at tactically moving towards fixed income as an asset class. Another reason was that in terms of real rates, or in terms of rates being adjusted for inflation, after a fairly long period of time, we'd seen that real rates had turned positive. And the view that we had put out is that even if RBI doesn't really increase rates incrementally, the fact that we were past peak inflation, the real rates would have a tendency to move further up in the positive territory. Historically, when we ran some statistics, we saw that in years like 2018, 2017, etc., when real rates were positive, they generated substantial returns for fixed income investors. So in our view, that sort of story is expected to unfold even now. We saw a bit of it happening, or rather getting accelerated, primarily because of the finance bill related amendments, where mutual fund taxation changed from LTCG, STCG to that of STCG for any investments happening after 1st of April. And for investors who really participated in these sort of markets over the last 2 or 3 months, have seen almost 12 to 15% sort of annualized returns in government bonds and AAA bonds. So without even taking any incremental credit risk, people have made that kind of money. We believe this story is still not over. The 10-year, which is trading closer to 7%, will clearly move down towards 6.5% in the next 6 to 7 months. So if you have portfolio allocation towards bond funds, which typically have much higher duration, 5 years plus, they will tend to benefit from this. And one must allocate till the time we really don't see, like we've been saying through this call, that equity becomes really, really compelling. Right now, equity is more fairly valued. One can nibble into equities, stagger over the next 4 or 5 months, and build portfolios with a 2-year view. But fixed income can be a more of an immediate allocation to start looking at returns over the next 1 odd year.
Saurabh, just out of curiosity, can you just tell where 10-year peaked?
10-year peaked at around 750, 7.5.
Yeah,
so you've already seen a 50 basis rally.
Yeah. So just to kind of give you a more direct answer, the 10-year peaked at 750 when a lot of investments went into debt. One part of the opportunity was taken then, and the yields are now come to 7. So maybe 50% of the opportunity has gone by. What Saurabh is also saying is from 7 to 6.5 is another phase of the opportunity, but it's not a decadal type of opportunity now, because the correction has already happened from 7.5. But clearly there continues to be opportunity from 7 to 6.5, which could give you slightly higher returns.
Thank you. The next question is around real estate. I'm not too sure whether, but
Actually, there's one more question, Radhika. It's on the Nasdaq and currency changes.
Sure, please.
So if I can take that, benefiting from currency changes and investment in dollar terms. I mean, that's the broader question. So thank you, Mr. Joshipura, for bringing that out, because clearly that's one area that I think, or we think as a house, that Indian investors really have not warmed up to enough in terms of diversifying outside of the home currency. To just give you a quick example, last year, calendar year 2022, if an Indian investor at the start of the year would have even remitted $1 out and put it in a bank outside of India, he or she would have just made around 10% returns purely because of currency depreciation. Now, while that could be a 1-year aberration or a phenomenon, but if you were to look back and extrapolate this or expand our horizon to the last 10-12 years, you will see that year on year rupee has been depreciating anywhere between 4 to 5%. If you look at the last 2 decades put together, rupee, the trend continues to be that of an annualized depreciation of 3 to 4%. So clearly it does have a merit in terms of diversifying outside of home currency. That's one from a currency angle. The other point is that in terms of opportunities, whether it is the size of the market, the sort of investment opportunities, products that are available, the kind of structuring that one can do, I think the global markets are far more, or they offer a far more larger canvas to sort of participate in versus that in India. There are a lot of leveraged products. There are a lot of products that they participate into newer upcoming themes. And that's one place we think should find some allocation, meaningful allocation. By that I mean close to 10-15% of your allocation into dollar assets. Just one example of a product that we're doing, because you raised the question on dollar investments. A lot of us talk about diversification on lack of correlation, of assets with each other, so that in terms of volatility, when markets are volatile, portfolios are more resilient. So we've tied up with one of such our partners. It's called the Black Oak Fund. What this does is it buys and sells insurance policies in the US market. There's a large secondary regulated market in the US. The fund has been operational for the last 7 or 8 odd years. They run almost $650 million of assets. They try and identify policyholders who have, who actually don't need the policy anymore. They'll all be towards their late 70s, 80s in terms of where they are in their life cycle, and not too much of a need for them to service these policies. But the downside is that if they just let the policies lapse, all the money that they've invested over these premiums over the last many years goes down the drain. So a secondary market buyer or a fund like this steps in. They decide to pay the remainder of the premiums till the policyholder is alive, and the policy gets assigned to them, and they reap the benefits of the maturity proceeds or the death benefits of the policy. Why it's interesting is because irrespective of COVID, irrespective of rate hikes, rate cuts, whatever you call it, this fund has been able to deliver a 13 to 14% sort of annualized IRR on the portfolio in dollar terms. Imagine now you add another 2 to 3% on it from a rupee investor perspective, and you're getting a 15-16% sort of return purely without any correlation to the market. So some ideas like these, one can participate. You mentioned about NASDAQ, but that's a very crowded trade. Everybody knows that NASDAQ is something which one can invest into. But again, that's volatile. We saw the last year, NASDAQ moved down by 35%, while it's clawed back half of its losses this year. But that is still related to the markets. So something like this, is what we do offer, and we definitely see, merit in allocating there.
On real estate, while the question is real estate, do we have a product? We really don't offer anything in real estate, right, Saurabh?
Yeah, so we don't have any direct real estate product right now. What we had offered maybe a couple of months ago was something to do with commercial real estate, but that was more of an equity product. So we had partnered with a leading asset manager. The idea was basically to try and buy land parcels and build them along with professional managers in terms of commercial utilization. So these were large grade A commercial complexes, like the ones you might see in any of the top metros across the country, with large floor plates and clearly targeting the top MNCs or the top Indian companies who employ people across software, banking, financial services, etc. The idea was to participate in the entire cycle of the product, from building it and then to make it operational and leasing it out, and eventually to sell it out towards some of the strategic partners.
No, but Saurabh, we don't have anything right now.
So that product is still live. One can participate, but no real direct real estate product, to answer your question.
Yeah, but if you, I'd also like to add that while we do not have a product right now, real estate will emerge as a good asset category at some point of time, because it's been out of flavor for some time in India, but we don't really have a product right now.
Sure. No, and there are some proxy plays also, Nitin, if I might just add to that. So for example, we are in the process of onboarding a product with a partner which actually participates into the warehousing space. Now, while it's not direct real estate, but warehousing is quite a hot trade in the country. We participated with them in the first fund. The fund's delivering around 20% sort of IRR. And the life cycle of this product is relatively smaller, given that construction of warehousing and leasing it out or selling it out is a much shorter process compared to building a residential or a commercial project. So that's another play which can be interesting, given the kind of e-commerce boom that we're seeing in the country.
I think Saurabh, you can take the next question.
Sure. So the next question is on if FIs, MFs are buying, SIPs are strong, why is LIC selling? While I will not have a view on why LIC is selling in particular, could be any of their internal reasons, could be realignment of portfolios or rebalancing. It's not just LIC. The DII number X of MF, which I showed, actually has other insurances also. So that could do with some of their own internal portfolio rebalancing.
No, I just want to add, LIC will always sell when the market is at its peaks. And FIIs, so that's LIC strategy through the years. And their job is also to protect the market in some form. Earlier, it was just LIC and FIIs or domestic institutions and FIIs. Today, retail is a very strong participant. So the way I look at LICs, they build their buffers in peak periods of the market, and when markets fall, they try to be contrarian in their strategies. Last question. The next question is, what is a good platform business to invest now, listed or unlisted? What opportunities you now have at InCred? See, we believe in platform businesses in some way. We believe in the disruption that is being created in this space. We right now don't have any listed recommendations, though the performance of the listed platform businesses have really improved, and to that extent, we may have a favorable opinion on listed platforms like Zomato, PB Fintech, etc. But we think valuations are still costly. We prefer unlisted in that space. We keep showing some opportunities, and we will get in touch with you on unlisted platforms. Will always be at a discount in valuation to listed platforms. In unlisted platforms, we prefer to look at 100 to 500 crore kind of valuation ranges for entry, because finally platform businesses go beyond 10, 15, 20,000 crore valuations if they do well. So we prefer unlisted, and we will show you some opportunities through our RMs there. Saurabh, that's a fair response, right?
Yeah, Nitin, agree with you totally.
I think
General election impact if government changes.
You want to take it? You want me to take it?
Yeah, I'll take it. I've asked my boss this question, and hence I told Saurabh I will take it. If the government changes, you will see a fall to that level of the mean that I told you, and then the markets, which is maybe 20% kind of logic, and then the markets will rebound gradually to the mean growth path. Two views. One, the country is always run by the bureaucrats. So to that extent, policies and all will more or less remain constant. But there is the impact of the current government which has come in. So if there is a change, I would expect a correction on that phase. But what are some of our fund managers are saying is they expect a strong pre-election rally kind of thing before the elections. And right now, no one is really, in spite of recent developments, no one is really talking of government kind of change in most conversations that we have with people. So right now, there are no concerns. We will see how it evolves. But since the question was what happens if the government changes, clearly there will be a sharp fall. But that was just
one point there, Nitin. While I'm not wanting to comment on what happens, whether it will change or not change. But what I'm trying to say is that we have ways to even play that possible event, however low probability that might be. So what we do as a house is that we also issue market-linked debentures or structured products. By that, what I mean to say is that we try and create scenarios which are around the Nifty predominantly, trying to factor in what could be the probability of different events playing out. If the market remains sideways, if there's a rally, runaway, or if there's a fall. Most of these products are generally structured in a manner that if held to maturity, principal at all points in time gets protected. And at the same time, it helps you participate in the market, by way of payoffs, which are some complex strategies we run around derivatives, options in particular, and try and provide a return which is better than the market, at the same time giving you some sort of a downside protection or insurance. So that helps one to really get over some of these, you could say, a point in time sort of event risk, and at the same time stay invested and not really be on the sidelines, because our markets really move very, very sharply. And if you miss out on those few days, you tend to miss out on the year's return. So that's another way to play any of these changes happening. Thank you.
Yeah, that's a good point, because most of these structures target on small moves of the market 12 to 14% kind of IRRs. So yes, that's a kind of portfolio insurance that is kind of offered. There is a question on disruption in few sectors, power and transport, and since I mentioned it, I would, Saurabh, I'll take it, I think. The point that I'm trying to make is that when you invest into the future in maybe unlisted kind of sectors or small caps, what are the sectors which will do well in the future? And we often hear many themes which are coming out from our IB equations with people, etc. So on the IB space, for example, we are seeing a lot of opportunities, a lot of discussions happening on battery development, on there's a listed company called Olectra Green Tech, which is doing bus development in electric space. We recently did a fleet company because there is a belief that in transportation, people will move away from owning cars to doing more of the Uber kind of transportation. And to that extent, we got our investors a company called Everest Fleets, which supplies cabs to Uber and is very profitable. And we got it, Uber invested at 2,000 crore kind of valuation. Our investors also invested at the same valuation. We think that's a 3x kind of story over 3 years. So we think in transportation, those are the kind of stories that we kind of look at. Power is very clearly in terms of green energy, hydrogen, etc. We don't have any recommendations, but it is mainly the more private sector oriented power companies, etc., which are in putting things in this space. But clearly, we are looking for disruption themes in whatever we do in the unlisted space as guidance for our investors.
Radhika, are there any further questions?
No,
No,
I
I think-
think those are all the questions we had today. Thank you so much, everyone, for joining us. And thank you, Nitin and Saurabh, for those brilliant answers and some very nice investment ideas. We hope to do this more often. And in the meanwhile, any of you have any further questions or interest, please do reach out to your relationship managers and private bankers. Thank you so much. Have a great week.
Thank you. Thank you, Radhika. Thank you, everyone.
Thank you.